All right, so the market did not come crashing down into oblivion. We've seen a pattern like this before in the past. So this is nothing new. Unless you started investing last year, this is nothing new. I'm going to break down that pattern from a technical perspective, try to keep it real, right? We're going to look for expectations based on past precedent. And see what we can do. Then we're going to take a look at, within this volatility that we're getting intraday of the last couple of days, is there a prevailing theme, one intermarket trend that we're seeing? Of course there is. And I'm going to break down, okay, what can we do with that to take advantage? So let's go ahead and get started. Today is Wednesday, February the 7th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that have found this over the last few days. Hope you keep coming back for more as you see the kind of content that you get out of these videos day in and day out. Subscribe to my YouTube channel by clicking that red subscribe button right down below the video. You can do that right now while you're watching. Also, click the thumbs up icon that's right down there too. That lets me know two things. It lets me know that you liked the video today, you got something out of it, and that you want me to do it again. You want us to do it again tomorrow. One click, very easy way to give us feedback and tell us what you're thinking. Also, comment on anything that stands out to you. I love to see what you're getting out of this video, and the only way for me to see that is for you to comment down below. Also, join my daily email list. I send out an email every day with a hyperlinked timestamp summary of everything we talk about day in and day out in these videos. So make sure you're on that list with that link down in the description below. Follow me on Twitter for more content in addition to these videos. Even if you're not a Twitter person, if you like these videos, join Twitter, create an account, follow me. There's my handle at the screen up there. Make sure you're also following Brandon, and you're also following the Market Scholars account as well. Like and retweet tonight's Market Outlook tweet. We've kind of gotten out of the habit. The numbers have coming back down. Let's get back in that habit to make sure Twitter keeps pushing you all of my content. Also join almost 850 now of others who watch these videos day in and day out in our Market Outlook community on Facebook. You'll see the address on the screen at the top. There's also a link highlighted down below in the description that will take you there as well. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. Long upper shadow today, not so positive. But again, when you get a deep lower shadow, and you can see, we're going to end the week, barring a collapse again by the end of the week, which I believe is unlikely. We're going to get a long lower shadow for the week. And of course, long lower shadows, and previously when you get them on a weekly candle, tend to be very bullish. I just don't think, eventually, I think that, those, you can come in and trade within, you can see a couple of times here, you trade within that long lower shadows range. These happen to be both below the 200-day moving average, and that one too, was pretty deep. That one, I believe, got to the 200-day moving average, if I remember correctly, on a weekly chart. So we're getting a lot. We'll probably end up with a long lower shadow. We'll probably trade around in this area here by the time the week is done. We could bounce right back up. If we're going to get a big move one way or the other by the end of the week, which again, if you take a look at the at-the-money straddle, we're looking at what, the 2680? You look at the at-the-money straddle here, we're looking at about 50 points roughly, 52 points, up or down, is what one standard deviation is. So, you look at 50 some odd points up or down at SPX, whoops, on this chart here. 50 points, we're looking at 2730 some odd. So that's up in this area, and 2630 would be down in here. So that's one standard deviation move. If you look at two standard deviations, which right now we're kind of in three standard deviation mode, right? Then using the analyze chart, you can see we got 2814 to the upside, 2554 to the downside. You set those slices to the charts, and this is what it looks like here. That's a two standard deviation move. So you can kind of see we can pretty much recover this week, well, up to last Friday's open, where we opened up last Friday, in a two standard deviation move to the upside. Or we can create new lows and hit some support down here to the downside. Most likely, if we were going to get a two standard deviation move from today, by the end of the week, it will be above 2,800. I would venture to guess. Again, just considering that volatility is high, and the low point that we're hammering out here in this piercing line that we've had. Now we didn't close above this piercing lines. We didn't close above yesterday, so a little less bullish than what that candlestick pattern normally would suggest. But you know, we've hammered down here. We've got down to 2,600. We popped right back up to 2,680, all the way up to 2,725 today at today's high. So you know, there's a pretty good chance that there's a low point in this area. Doesn't mean that we can't come back down in this area, whether it's this week or next week or the week after. There's been lots of times when we form that long lower shadow that we still subsequently trade within that range, using the low point of that candle, right where my cursor is, as the support level. Obviously, short-term sentiment's recovering. The intermediate line's up above 50. This would be a bearish high point, a lot lower than the last near-term high. In fact, we kind of have to move these here, and then there's your last near-term high point up there. So we're not going to be forming any. In fact, we have to create one for this, and we're not going to be forming a new higher near-term high anytime soon, at least on this current intermediate near-term run. Most likely we're not going to do that. The intermediate posture is below 50, intermediate lines below 50 now. It's a you know, we've got the potential here, so we're going to duplicate that. We've got a new intermediate low point forming, which is, you know, we've talked before. Here we go. Move that over here. There we go. There is, I'm going to have to make that one blue. So we'll duplicate, we'll change that one, because blue means, in this case, blue means that it's still going, right? So, and I'm just using the orange lines, and you notice, again, we hit 50% Fibonacci on Monday. Yesterday's low point hit the 62% Fibonacci retracement, which lowers the odds that we'll form a new intermediate high point up above. And you notice again, this line right here is a 38% Fibonacci retracement of this market sentiment run that we're actually still on, because we're still well up above 80 on this market sentiment line. And since we crossed 80 right there, now this is kind of normal now. You know, I've shown you before that when you cross above 80, you don't get very much gains from that point. And we did this time. We got a lot of gains from that point, and just like that, we've lost all those gains from the time, most of the gains, that time we crossed 80. That's actually now normal, which is so weird to think with all this volatility, both to the upside and the downside. We're obviously still up. We're now, I mean, even after this low point, we bounced up. But again, you typically don't get too many, you know, the market doesn't go too much higher once market sentiment line crosses up above 80. That's a strong bullish move just to get to that point, typically. Not so much in this case because we were already coming off of a low point above 70. But again, you know, the markets, the low point, the move that we've had off this market sentiment low, which is the election low point, has been unbelievable. It's been outstanding. It's been a great market sentiment move here. So when you put it all into context, when you put all of this into context, you can see this big sudden decline is a normal retracement of a great, outstanding move that we've had since November 2016, since the last time market sentiment bottomed out below 50. All right, that's the S&P. The Dow Jones Industrial Average looks very similar, forming the intermediate line below 50, but market sentiment still easily above 80. Short-term sentiment improving. You look at the Nasdaq Composite, you know, coming again, all of these forming these piercing line candlestick patterns with long upper shadows today, all showing similar market sentiments. Market sentiment above 80, intermediate posture below 50, short-term sentiment improving from extreme low points. Russell's a little different, didn't quite get that piercing line, long lower shadow, but didn't quite get up above the midpoint of that candle, which is technically what a piercing line is. Not as big of a range today either, so because of that, short-term sentiment hasn't improved as much. Market sentiment is below 80, forming this forming this divergence there with the low point in between right there. And we talked about breaking below that, how bearish that was on Monday, but forming a long lower shadow and trying to get up above that. So a little bit of a fake out so far around this 1500 plus area for support. So we'll see if we don't get back up above that and again kind of trade more in this area here. Those piercing lines are what I was referring to here with this tweet. For those who are unfamiliar with that candlestick pattern, it's a strong bearish trend, strong bearish move typically on one day, like we had on Monday. We open below, so we gap down, so the bearishness continues overnight, and we gap down in the morning. But then we rally the rest of the day, close near the high of the day, up above the midpoint of this larger range. That tends to be a bullish reversal pattern. Considering, again, the long lower shadow of the week, that doesn't necessarily mean we're going to go right back up to 280. Even though, again, if we're going to make a 2 standard deviation move in the next 2 days, it will most likely be up to 280 versus, say, down to 255. That's less likely that we'll get that kind of a move. More than likely, we'll stay within that 1 standard deviation move and trade in this area where my cursor is here. And again, remember, to make sure you're getting this content that I put out there on Twitter, you have to like and or retweet these. The more you do those two things, the more Twitter says, hey, this person, they're engaging with this person's account, my account in this case, so we're going to keep pushing to them all of their tweets. And like I said, I always pin today's market outlook tweet at the very top, so it's always pinned there. That's an easy one to like and retweet. And what I get out of that is, the more that you do that, not only is Twitter going to push it to you, but what I get out of it is they push it to all my followers because it's an engaging piece. So the higher the numbers there are here, the better it is for everybody who follows me, and for that matter, everybody who follows this type of stuff. That engages with other tweets similar to this, they'll continue to get, Twitter will push this out to them too. So whether you have followers or not, whether you are a Twitterer or not, liking and retweeting helps you and helps me. And again, our new goal, our stretch goal, is to get that number, at least on the likes, up to 150. We've got over 120 before. We've been dipping back down below 100. So if you're watching, you're on Twitter, just run over there while you're watching, click that like and retweet button. All right, so now we'll go over here to the long-term chart, and you can see that long lower shadow, very evident there. That's very bullish on a weekly chart. Lots of examples of when we get these long lower shadows, we bounce right back up. See, here's an example of still coming back in the range, using that for support. So we never did close below that. We came back up from another one, and then we rallied. Look at that. 1, 2, 3, 4, 5, 6, 7 out of 9 weeks, 8 out of 10 weeks that we went boom from that low point of 1810 here. So, and we've talked about this before, but oops, move this down. No, I don't want to move that one. I want to move the line. Move that down from the low point up to that 10-week high close. And you can see up here 15.5% move in 10 weeks, so 112% annualized. So, again, there's precedent for this pattern to be bullish, but it doesn't have to be immediate. But it can be eventually very bullish. That's why we talk about, if you stay balanced and you don't get too overly positioned one way or the other, bullish in this case, and I've talked about, the risks that are involved with being this high above these moving averages, and to balance those risks while still following the trend. As long as you stay balanced and you don't get overly positioned, when this comes down, then you can look at this as opportunity. And that's, again, why I think what we're going to do with Market Scholars here, with Brandon, with how he teaches and the classes that he's putting together, that we're going to be teaching you, the trading rooms are going to be teaching you, the ones that I'm going to be teaching you, the way that they fit together between our two styles works perfectly for you to be able to balance, to have balance in your portfolios from a long-term and an active trading perspective, so that they work together to keep you always looking at something like this, instead of like, oh no, now I can't do anything, to like, oh great, now what can I do? Because there's going to be plenty of opportunity now with this increased volatility, especially from a technical perspective. You look at the 3 green arrow chart here, and you can see there too, you've got obviously 3 red arrows right now. We're well below all these moving averages. You can see how low the MACD is. We haven't been, the MACD hasn't been that low. Whoops, not 2 days, 2 years. The MACD hasn't been that low since way back there. February of 2016 is the last time the 8-day moving average was that far below the 17-day moving average, which doesn't seem like a lot, but you can see that's a big decline. And again, I did get an email, and I'll respond here because I think it's a good question that I want to respond to everybody. I talked about before how the MACD generally does this, right? We typically don't go from extreme highs to extreme lows like this. Now, you know, usually, I mean, the unexpected can always happen, right? That's why we position size. That's why we manage risk, because the unexpected, like what we've just seen, can always happen. Even though a lot of people say, well, this was always expected. Well, yeah, we were walking a tightrope at a very high place, right? But when you're walking that tightrope, little headwinds, little winds can push you off, and the unexpected can happen. This was unexpected. This is not normal according to past precedent. Past precedent shows when you get this high, we typically grind lower. So when we get the unexpected like this, when we decline this far, this fast, then the expectation now is we'll bounce back up that far, that fast. Whether, you know, I probably won't get to that high again because we had never been that high before. But don't be surprised if we don't get back up towards this 2025 level on the MACD very quickly, because again, that's not a typical move. The typical move was a slow grind. So hopefully that answers your email. But I think it was a very good question that I wanted to address, so everybody had that idea. Because I'll continue to say the next time we get up to 2025, we'll look for a slow grind, and for the moving averages to go from a parabolic move to a flattening move. This was unexpected, and look for it to bounce right back up and get to that high MACD level again, and then follow its typical pattern. This was obviously not typical. When you look at today's candle, you can see it was, you know, we didn't get higher highs and higher lows yesterday. We got a lower high and a lower low yesterday, but we closed the low was right at the open and the high was at the end of the day. So that was bullish from that perspective. Today it's the opposite. We did get a higher high and a higher low, much tighter range than what we've seen the last couple of days, and that's going to continue to tighten up. But you see is different. The high of the day was relatively early. It's kind of in the right at the European close, and then we close at the low of the day, which is more bearish, and actually continuing down in the after hours as well. It's right about in this area here. So pretty bearish candle, or not as bullish, not bearish because it was a higher high and a higher low. But again, look how wide this is the 4-week range, and it actually happens to be in the 2 weeks here too, because it's very recent. But that's a wide 4-week range. Same thing applies to the upside, right? When you get to the upside, when you get a wide range, you're going to typically trade within the top half of the range until it tightens up. And again, this is not typical. It didn't happen that way because we move so atypically to the downside so fast. But now when we get this kind of a move, this big of a range, the lower half of the range is going to be bigger than normal, so you can kind of see where it's at. The high's up at 286.5. The low is at 258.5. So we're looking at get my calculator out to make sure I get the math right. So almost a 28-point range right now. It's a large range. It's more than a 10% at the top end. Or almost 10% at the top end, more than 10% at the low end here of the range. So it's a pretty darn good range here. And then again, you add that to the 258.70 low. Then whoops, sorry. Here, that's minus 27.88. All right, so 27, let's see, let's store that. 27.88 divided by 2, there we go. And add that to the low end of the range. And we're looking at 272.64. So right in there. We got almost there to the top, to the midpoint of the 4-week range. It will act as a resistance level. Once you get up into that upper half, then great. We're back to being bullish again. We won't be pushing up that top end anytime soon. Trust me. But until then, while you're gonna have some volatility while you trade in this lower half. This is that long weekly lower shadow right here. We can still fill that in the next week or two without necessarily going to new lows, but still fill in this big, because we're not going to be moving that down anytime soon. This top one, I mean, that's, we've got to clear all these days before we start moving that one down. And even then, we got a few more days of it being right about here before we really start pushing it down. But I would venture to guess, considering how wide this range is, that we'll probably get back up into this area by the time we have to start moving that down. So that's kind of the expectation I'm looking for based on what I've seen in the past with big ranges like this and big, long, lower shadows on the weekly candles. We take a look at the range here, and again, like I said, we had a 12.5 point range on Monday. Before that, about a 5 or 6+ point range, so it doubled. And then yesterday, 11 point range, very huge range, back down to about a 5 point range. So, you know, that's still very high. And the volume you can see is really dropped off, 166 million. So let's put that in context here. So a 5 point range is still very high relative to the average, you know, which is over almost 4 points, and that's really high. But again, it's not like we haven't seen it up at these levels before. Back in 2016, we got the average range got this high, and look what happened. And back in 2015, this is the last time we've seen a move like this. Got the average range up this high, and that's what happened. So, you know, this is the expectation here. We'll probably see something like this here going forward. Because again, earnings, from a fundamental standpoint, nothing's really changed. There's just a lot of volatility. And we've seen that before in early 2007, and the market continued higher all the way up until October 2007. The volume, 166 million, is still up above the average, which, you know, is higher than it's been in a long time. And the volume's not nearly as high as it was. The average volume isn't nearly as high as it was back here in 2015, 2016. Here, let me get to this chart here, and we'll go back to those same levels to look at the average volume, which you can see got really, really high. You know, got 500 million shares trading in one day. That August 24th, over 500 million shares. We got up to about 350 million, and we're already back down. You can see the 1.5 times the average volume got over 300 million. We're not going to get the 1.5 times the average volume is not going to go over get to 300 million this go around. Probably will get over 200 million though, which we haven't had for, you know, since the beginning of 2016. And again, both those times produce low points, and you can see how it grinds down. Volatility will most likely do something similar. You can see volatility that needs to move up here and now change. So we'll put that up to a green. You can see how it flattened out look how it flattened all these out. We just haven't had this kind of a volatility move in a while, but now we're forming a low point. And again, it's not going to be below 12.5, so we're going to have a higher low, but I don't think the next peak is going to be at 40 or 40. It might get up to 27.5, 30, and then we'll get a lower high, and we'll start working our way back down to lower lows. And again, for some precedent on when we've had volatility this high before in the 30s and the 40s, that's been a while, so we need to go back further. So there's August 2015, last really significant time we had that. So let's zoom in on that. You can see we got up, came down a little bit, formed a lower high point around 32.5. Then we started to work our way down more slowly, got up to 27.5 before eventually getting back down below 20 and working our way back down to the low teens. And again, something similar here would be again to form a lower, you know, you're getting some long lower shadows here after a long upper shadow yesterday. Very bearish for volatility when you get that long upper shadow. But again, look for a peak around 30, you know, shorter term peak around 30, grinding back down to 20, bounce back up, and eventually breaking below 20 will be significant, as that will push us back down into the teens eventually. Again, according to what we've seen before with this type of a move. As weird as this move has been, we've seen this before, right? Now, if you just started investing a year ago, 2 years ago, you haven't. But if you were here in August 2015, you've seen this kind of move before. And, you know, again, we've seen what happened after the fact. And there's no reason to believe that we can't get that kind of a move again after the fact. Whether or not we'll, you know, have multiple years of bullishness like we did then, you know, that's probably unlikely considering how mature this bullish cycle is getting. But still, it doesn't mean that we can't expect 2018 to still be a pretty good solid year as we were expecting, you know, at the end of 2017 with how bullish that year was. But we also said that despite the good news, in fact, that was something I tweeted out again yesterday too, Just seemed like, well, here, this one right here, I just tweeted that out at the end of January about how when you get strong Januaries, you expect to still have a really strong year, but that really strong year, and you know, that, so you can see these really strong years after a 5+% January. That's the full year results. 25% average for the year. 16% on average after January, after that 5% move, but not without a correction, right? Not without a nearly on average 11% decline sometime within that February 1st to December 31st time frame. All right, let's talk about what's driving the price action today. And there's actually two different things, and it didn't really have anything to do with the economic calendar. One of them, it's been largely driven by the drop in bond prices. And remember, stocks kind of lag bond prices. So the drop in bond prices and commodity prices. Commodity prices were hit hard by inventory data. You can see crude oil here started strong, and bonds weren't down very much, and so stocks were rallied. But once stocks, from the time that stocks hit their peak to their low of the day, which is at the end of the day, you can see energy pulled it down, and bond prices, that decline in bond price, which means bond yields moving up, pushed it down. And there was no, like, the dollar was strong today. The dollar was the safe haven. The dollar's been very, very weak, remember. You can see from a long-term perspective here. In fact, let's look up the long-term chart. You know, here's the U.S. dollar. The dollar's been very, very weak. And it's forming on a weekly chart here a little bit of a morning star candlestick pattern where you have a bearish move first of all, then you have at the end of a bearish move, potentially at the end, because you never know what the end of the move is going to be. But you know, what could be potentially the end, you have a longer range, a small doji pattern for the second candle, and the third candle reverses the first one to the opposite. You know, it's the evening star to the upside and morning star to the downside, you know, reversing a downward trend. So this would be a bullish pattern. Of course, closing up above these highs would be confirmation of that bullishness. But you notice, I mean, we were pretty far below the 50-day moving average, and we are pretty well below the 200-day moving average. And there's a little bit of a divergence forming here. So this is the MACD of that 200-day, and there's a divergence forming on this. So with the target of that divergence being up here at this 95 level, you know, that bullishness in the bullishness in yields, you can see getting up to 2.85. You know, the strength in yields has coincided with weakness in the dollar, incidentally. But now with yields being, you know, that movement of the yields, now that yields have reached a peak, have reached a high point, that will now put people into the dollar, and that will pressure commodity prices, especially. You can see crude oil has been doing very well and is looking a little weak with a little bit of a reversal pattern. Not trend-changing reversal pattern, because it can pull back. You know, it's pulling back to the 50-day moving average right now, and there's still a pretty decent gap of momentum between the 50 and the 200. And you can also see that weakness in the dollar help gold get up to 1350, meeting some resistance right now, coming back like it's done before. So a little bit of a pullback in these commodities and these metals. Sorry, I can't think right now. Go like gold. But as we've seen, so that the strength in the dollar, as we saw before, when the dollar was dropping, yields are rising, and they got to a peak, and that now is bullish for the dollar when it's high, when yields are high. Well, now as the dollar rises off of a lower low, so I'm not looking for new bullish trend in the dollar, but at least a pullback move in the dollar as the dollar rises. Then, as we've seen, the relationship would be for yields to fall back down, and for yields to fall back down, that will be, at least in the short term, bullish for the for stocks, because stocks have been bearish with yields as high as they are. So, yeah, we're kind of, you know, messing around within this range of the long lower shadow on the S&P 500, but eventually, as we've seen before, bullishness, and from a fundamental standpoint, that's where the bullishness will come from. It will come from yields pulling back down towards that 2.6% area, the dollar rallying as we pull back, putting pressure on commodities and things, but helping stocks bounce up off this really volatile bottom that it's trying to hammer out right now. From a sector rotation, you can see industrials. Industrials were the biggest beneficiary. Financials. You can see consumer stocks also leading the way to the upside. Technology to the stock market peak. But as we went from peak to trough to low point, by the end of the day, with crude oil bringing us down and bonds bringing us down, and yields rising, you can see financials, everything fell, and you can see it. You see how the correlations, how I've said before, when the market's going up and up and up and up, correlations drop because different sectors take their turn, leading the way to the upside. When markets come back down, and they come back down hard and fast, look, everything goes down. Everything goes down, and correlations start to move back towards 100%. Now, eventually, utilities will stop going down very much, and especially considering they're so low as it is, and real estate or consumer staples will stop going down. They'll start holding their value. But at first, when those correlations bounce off those lows, everything goes down together. And you can see energy's down, technology's down the most, financial's down the least, and healthcare's down the least. But they're still down, 1.15% relative to the market's 1.6% drop. So even though it's outperforming, it's still down. And shoot, with a half an hour to go in the market, healthcare, industrials, and financials were almost at break even for the day when the market bounced back up here at the end and got to only a 0.6% loss, but then dropping back down here. In fact, from that peak down low, everything fell except for utilities and real estate. They fell too, just not nearly as much. And those are the ones that have been struggling the most, is real estate and utilities, right? They've been down here. They're starting to hold. In fact, from the low point here, from the low point that we had in stocks, we could say probably right about there was the low point on yesterday, and we bounced back up to this high point. You can see the biggest winners of that bounce of a 3%, almost 3.5% increase in stocks from low to peak. You can see it was financials. Well, here, let's do it this way. Let's look at it on a really short-term basis, because some of these candles were much bigger than just a half an hour. So there we go. So it's actually the low point of the markets was right about there. So it was early in the morning, and then we bounced up a couple times, low, bounced up again by the end of the day, and continued higher. So from the low to the top, the market was up almost 3.75% from low to high. Look at that. Technology, consumer discretionary, industrials, your typical bull market sectors led the way higher. Utilities and real estate both up 2%, but lagging significantly behind the broad market. You can see energy stocks too lagging. So as they come back down now, again, technology, industrials, right there, consumer discretionary, all kind of matching the market down. Energy coming down too, not surprising with the drop in crude oil, and financials not coming down as much with the rise in bond yields. But don't expect these bond yield rises to last too much longer, right? The dollar was to bounce higher. We've seen that that's had a negative correlation in the short term with yields. So look for those high yields that's producing a lot of this dollar interest to start to lower itself back down again, and that will put pressure on financials. So don't buy a lot of that relative strength right now in the financial sector. And with yields coming back down, look for opportunity in the sectors that have been struggling the most. Those interest rate sectors that have been struggling the most, that are providing some decent opportunity right now, especially in the last 3 months here. You can see utilities down 12.5%, and real estate. And you can see from the market's peak here, they're still struggling. They're not struggling as much, but they're still down on the market. So they're still providing opportunity. There will just be short-term opportunity, right? Because we don't expect yields to enter a bearish trend anytime soon. They're on a pretty strong bullish trend, long-term bullish trend right now. All right, so for our trade example today, we're talking again about this dollar bounce, not bullish trend, right? Just a bounce, short-term bounce, putting pressure, as we saw today with commodities and eventually with bond yields. The dollar, rising it brings yields down. But all rising because yields are so high, but then we've seen the short-term correlation has been negative there. So that continues to be the case. Of course, stocks like Freeport-McMoRan, which has broken down below these moving averages, not as sharply. You can see it's been more of a grind. This is what you'd expect from the market, and you see it went parabolic and then flattened out. That's kind of what we talk about there. So we've had the typical move, and now we're down. We've broken down below the 50% Fibonacci retracement. We bounced back up with a good bullish engulfing, but only to the 8-day moving average. We hit it, and we continue back down. You can see there's some support here at 19 that we broke below that can act as a resistance for past earnings, but still volatility is relatively high on that. You can see up here at the 59th percentile. So there's opportunity to sell options. We can sell at that $19. We're not going to get a lot because the stock is so cheap. Your premiums don't get so high. So we're going to be below that 47-cent threshold that we typically like to get. But because the stock is so cheap, that's okay in this case. You're going to get a pretty high probability trade, and that's not including the fact that there's some pretty significant resistance there with moving averages heading down. You can see the 8 and the 17 are both now below the 19, and that's going to hold. That's going to act as some resistance as they head lower. And then, of course, the 30-day moving average, as it heads lower, will act as a resistance as well. So that being the case, there's opportunity there to position size, maybe up closer to normal on this case for this kind of position, because you have higher odds from a technical perspective as well as a probability from a volatility perspective. You have a higher odds working for you in your favor. So to summarize, the market's bounced off. It's formed its really volatile low point here so far this week. Most likely going to end the week with a long lower shadow. We still got one more day, a couple more days to work through, so we'll keep our eyes peeled for that. But expect some volatility in the lower half of this very wide 4-week range. But eventually, as we break through the midpoint, that's when we'll start to look for it to get through and get back up to the top end of this, again, like I said, very volatile 4-week range. So we've seen this play out before. There's a great quote that says, when the market is fearful, that's the time to be greedy. When the market is greedy, it's the time to be fearful. So even with today's trade idea, it's not like we went out there and bought willy-nilly. We're still being very picky and specific. We found an intermarket relationship that's going on right now, and we're going to take advantage. We're going to be very strategic in taking advantage of that. In this case, trying to take advantage of a short-term bullish move in the dollar by making a short-term bearish move with a higher probability on commodities in general, using FCX as a proxy for that. So that being said, thanks again for watching tonight. I hope you got some value out of that. Let me know in the comments down below. Remember to subscribe, like, and comment down below on YouTube, all 3 things, or at least 2 of the 3. And then, or if you've already subscribed, at least 1 of the 3. Follow me on Twitter for more content that I put out there throughout the day. Even if you're not a Twitter person, if you like this kind of content, you at least want to be able to create an account and follow me, Brandon, Market Scholars account. And then finally join the community with everybody else who watches these on Facebook at our Market Outlook community group with the link down below. Have a great evening, everybody. Brandon will be back on his normal time tomorrow. I'll see you on Friday.